Hey everyone, today we're going to be talking about interest rates, inflation, the relationship between the two, and how they affect the stock market. And as we go on in the video, it's going to get a little bit more technical because I think that's what's kind of missing on YouTube right now. There's not really like technical explanation as to why interest rates are really affecting the markets. So that's what we're going to go through. The beginning, I'll just kind of run through things step by step. So if you look here, basically at the very beginning, I want to kind of just more conceptually explain the effects of a rise in the federal funds rate slash aka the interest rates and what effect it has on inflation and the markets. So first of all, the federal funds rate is the rate at which banks and other financial institutions lend to one another. And it's something that is controlled by the Fed. And usually it takes 12 months for this federal funds rate to have a widespread impact, but the stock market is affected right away. So as you guys may know, over the past few years, especially since 2020, the federal funds rate was near zero, if not at zero. And so that meant that when banks were kind of lending to each other, it was with a base of zero. And so if it when the federal funds rate increases to let's say it increases by like 1%, then all of the banks now need to increase their lending to one another, and financial institutions, they need to increase their rates by 1%. So that's kind of like a example there. And increasing the federal funds rate essentially decreases the demand in the overall economy. And that is the kind of relationship with inflation that we're going to eventually get to. But to explain that a little bit further, the reason that an increase in the federal funds rate decreases demand in their overall economy, there's a lot of steps to it. But the first is because the higher the rate, this results in higher mortgage loan rates, credit card APRs, and other consumer and business loan rates. And so businesses aren't able to borrow as cheaply and as often. They're not able to borrow as cheaply, and often they pass off these costs onto consumers by raising prices. At the same time, consumers have less money to spend because imagine if you have a mortgage and you have a variable interest rate, or you have credit card debts that you need to pay off. All of a sudden now your interest rates have increased, right? And so you have less disposable income, and because you're spending less, businesses are also earning less revenue and profits as well. So it's kind of a double whammy. And so as we look at all of this results in a decrease in demand across the economy, and this is kind of like a self-feeding cycle. So just to summarize again, higher interest rate results in higher rates that banks have to lend to one another. This leads to higher interest rates for across all different types of loans, including mortgages, credit cards, consumer and business loans. And as all of these costs increase to do business, it means that businesses aren't able to borrow as cheaply, and consumers also have less money to spend because their bills are increasing. And so all of that is feeding onto, or kind of compiling against one on top of one another, and so the demand overall just decreases in the economy. And so the other point that I need to make though is that the economy does not equal the stock market. And so when the interest rate rises or is about to rise, the market acts way more quickly, which is what we're seeing these days, right? The interest rate has not really even increased that much over the past few months or so, but the stock market has decreased very dramatically, right? And that's because the stock market kind of anticipates what other investors are going to do, or investors anticipate what other investors are going to do, and they try to sell ahead of one another, and that's what's causing the recent decline. So just to summarize again, I guess a rise in interest rates increases the cost of capital for business, it lowers consumer spending, and then decreases a business's revenue and cash flow. And the Fed is raising interest rates right now in order to destroy demand and force businesses to decrease their prices, ultimately to help inflation to come down. And I know I said something a little bit counter to what I'm explaining here, which is that businesses often pass off their costs to consumers by raising prices, and inflation means that businesses are increasing their prices, right? But this is usually what happens when you raise the interest rates, but my best understanding of what's happening right now is that because inflation is running so hot already, the Fed, what they really want to do is just destroy demand. And by destroying demand, businesses will be forced to decrease their prices because that'll be the way that they can attract customers, right? So like right now, if you look at something like oil prices, because it's so expensive, a lot of consumers may not be as willing to drive around, and that would decrease the demand of oil, right? And so businesses will have to decrease their prices in order to kind of attract those customers. And the same thing as if you were to go to like Chipotle and order a meal and it's like 15 bucks or 18 bucks instead of normally being like 12 bucks or something. Hopefully the Fed, what they're trying to do by raising interest rates is destroy demand and ultimately cause prices to come down. And we'll kind of see what happens. So that's the overall explanation of the relationship between interest rates, inflation, and the stock market. But I wanted to now go into something that's a little bit more technical. And it's something that I don't think is covered a lot on YouTube in particular. And this is like one like technical kind of explanation of how interest rates really affect the markets. So we're going to talk about something called your WACC, also known as your weighted average cost of capital. This WACC is, by the way, if a lot of this is going to be potentially new to some of you, and if you have not heard of what a discounted cash flow is, I have a video down in the description explaining what a discounted cash flow analysis is. But essentially, the theory behind it is that a company's value is its future cash flows, all discounted back to present value and summed up together. And so I guess like another way to put that is when you think about what a company should be worth, it's basically worth the cash it can create from now until the end of time. So that's the first kind of thing you have to understand. But then the second thing is $1 today is worth more than $1 tomorrow or 10 years from now, right? If someone were to come up to you and say, hey, I'll give you $1 million today, or I'll give you $1 million in 100 years, you should take the one today, because in 100 years, there'll be inflation and the value of that $1 million will decrease in 100 years over time, right? And also you can take your $1 million today and invest it into the stock market, bonds, etc., and you can earn money, right? So when I explained earlier the cash flows being discounted back to present value, that's like part of the whole like concept of what a company should be worth. You can't just sum up the cash each year that you think a company will earn from now until the end of time. You also have to discount each year's worth of cash flow back to present value. And you do that with something called your discount rate. And that discount rate is your WACC, also known as your weighted average cost of capital. So what does this mean? Your weighted average cost of capital is a formula, and the formula is your percentage of debt of a company times your cost of debt plus your plus your percentage of equity times your cost of equity. And your cost of debt is simply just the interest rate banks charge a company. So if you're a company like Apple, you probably have a very, very low cost of debt because banks will probably they'll trust that you'll be able to pay them back. So you might have like a 1% or 1.5% cost of debt. Now, if you're a super new startup and let's say you're like just getting started, you're a lot more risky. So the bank is going to want a higher interest rate because they don't know if you're going to be able to pay it back. So they might charge you something like 7% or 8%. So that's your cost of debt. So I know this formula looks really intimidating, but at least this part's pretty simple, right? Percentage of debt times cost of debt. By the way, the percentage, what that means is if your value of your debt is like 100 million, let's say it's 200 million, and then your equity value is 800 million, your total company is essentially 20% debt and 80% equity, right? So let me show you here. Debt, 200 million, equity, 800 million. The total is Wow, messing up here a lot. The total is 1,000, right? And so your percentage of debt is 20%. And then your percentage of equity is 80%, right? So that's all the percentage of debt and equity thing means. Now your cost of equity is a little bit more complicated. And your cost of equity is usually defined by the CAPM formula. So that formula is risk-free rate plus beta times your market risk premium. And your market risk premium is your expected market return minus your risk-free rate. So explaining what each of these mean, risk-free rate, that's basically what you can earn in terms of interest that's virtually risk-free. And usually what people use for this is the 10-year treasury yield, because the US government has very, very low chance of defaulting and not paying you. And usually that risk-free rate, or over the past, has been very, very low because the federal funds rate has been very low. And those two are kind of have a very direct relationship with one another. And then beta is how volatile your company is versus the market. And usually you can just find that on something like Yahoo Finance. And then your market risk premium is your expected market return minus your risk-free rate. And your market risk premium usually is around 6 or 7%. Your expected market return kind of will vary depending on how the market's doing or what the environment's like. And then risk-free rate is something we discussed earlier. And I'll go through an example below so you know what all that means. Risk-free rate, usually 10-year treasury yield. And the higher the federal funds rate, your higher the WACC in most cases. And I want to show you guys an example. And this is all going to go back to what we talked about earlier about how the federal funds rate affects inflation and the stock market. So I calculated this WACC here. And let me kind of go through this step by step. So we have percentage of debt, 20%, tax rate, 21%. Oh, I forgot to add something here actually. Oops, sorry about this. So percentage of debt times cost of debt times 1 minus your tax rate. So so going back to this, your percentage of debt is 20%, tax rate is 21%, cost of debt is, aka your interest rate, is 1%. And then your percentage of equity, let's say it's 80%. These are all fake numbers, by the way. Cost of equity, I calculated here. So as you see in this formula, it's your risk-free rate plus your beta times your market risk premium, which is your expected return minus your risk-free rate. So hopefully that was, I don't know, maybe that, I'm trying to ensure that was kind of easy to follow. So let me just go through it again in case it was a little confusing. So cost of equity is your risk-free rate right here plus your beta right here times your market risk premium. And your market risk premium is 6% here, right? That's just very simply your 7% minus your 1%. And what I want to show you guys is what happens when your interest rate increases. So here I have some other calculations that I did. Also, you can see here in this formula, before I go into this, this is just the actual numbers being applied to this formula here. So D29, so we have your WACC equals your cost of debt, 1%, times your percentage of debt, times 1 minus the tax rate, that's this section right here, plus your percentage of equity times your cost of equity, right? And so that's why we got a WACC of 8.2%. All right, so now let's see what happens when, oh, I guess I deleted this thing. Okay, so let's see what happens when our interest rate increases by 2%. Our federal funds rate now in this scenario has increased by 2%. In this scenario, you can see our WACC has increased from 8.2% to 10.1%, and let's see why that has happened. So percentage of debt, I'll just highlight in yellow or green things that have stayed the same. So your percentage of debt has stayed the same, your tax rate has stayed the same, percentage of equity has stayed the same, market risk premium is the same, and beta is the same, right? And then in blue, I'll show you guys the things that has changed. So because your interest rate has increased by 2%, I just made a simplifying assumption. This is not always directly so correlated, but let's say that our cost of debt has now increased by from 1% to 3% for our same company. And this kind of goes back to what I mentioned earlier. When you increase the federal funds rate, businesses aren't able to borrow as cheaply anymore because the rate at which banks are lending to each other has increased, and banks obviously can't be losing money when they're making loans or giving loans out. So that's an example of how the federal funds rate is directly changing the cost of capital for companies and cost of debt, right? And so that's one thing that has changed. And then if we look at our cost of equity, which again is this formula, our risk-free rate has increased from 1% to 3%. And that's because, remember we talked about how the risk-free rate, usually you can look at your 10-year treasury yield. And it doesn't always, again, like go so directly as like, oh, 2% change means a 1% to 3%. But in this simplified example, your risk-free rate has now increased because of what we talked about, of how your 10-year treasury yield is affected by the federal funds rate. And so that's another thing that has changed. And also your expected return as an equity investor has changed, because if bonds are more attractive now because your federal fund rate has increased, and also because when your federal funds rate increases, equities become less attractive, and so equity investors will expect more from their investments. This causes an increase in the expected return of equity. And that's what we have here, expected market return. So then if we look at our formula, this has now increased our cost of equity from 10% to 12%, right? So this has also changed. And so that's why you can see directly here our cost of equity, our weighted average cost of capital has increased as a result of this interest rate increase from 8% to 10%, right? So now, okay, this is great. You have all these numbers, but what does this actually all mean, right? So how does this affect the stock market? So that's what we'll go into next. And again, this is going to be kind of like a technical explanation. But these are numbers I pulled from my Google DCF, which I also linked to down in the description if you want to check that out. But these are numbers for Google. And I discussed earlier about discounting back to present value, right? And so that's what we're going to do here. So this is, and I'm not going to go too much into like what a DCF is, but I do want to I think that ultimately, if you guys watch through this entire like next few minutes, you'll see why this like increase in your weighted average cost of capital really actually affects the stock market. So the way that you discount your cash flow to present value is you get your free cash flow and then you divide by 1 plus your WACC, and then you power this to the year that you're in. But actually what I'm going to do is I'm going to make this a little bit more dynamic. So okay, so I'm going to change this a little bit. I'm going to move this over here and you guys will see why later. All right, so okay, sorry, I had to do one more thing. Oops. All right, so now I can just copy paste this across, and you can see that all of your free cash flow here is being discounted at an exponential pace, right? So you have 50 billion here that's discounted to 47 billion. Yet you have and as you go on, you can see that the difference between these are increasing, and that's because we're discounting back to an exponential level. So this one here is discounted back 10 years, right? And obviously when you do anything with exponents, things like increase a lot over time. And then terminal value, this is something, so let's say, I'm gonna just kind of go through this really quickly because this video is not really about the DCF. But the formula for terminal value is your last year's free cash flow times 1 plus your terminal growth rate. Let's say that's just 2.5%. And what we have to do next is divide all of this by your WACC minus your terminal growth rate. Let's say it's 2.5%. So that's our terminal value, and then our present value of that is your terminal value discounted to the last year that you're in. Okay, so and then enterprise value, aka just the value of your company, is like, as I discussed earlier, your present value of your free cash flow plus your present value of your terminal value. And so this is essentially saying that Google is worth $2 trillion or 1.955 trillion. And then to get to your equity value, you have to add your cash, subtract your debt. And I know I'm blazing through this, but it's just because I want to show you guys one thing. So let's see. Oh, wait, I did something that's definitely wrong here. Last year free cash flow times 1 plus your terminal growth rate divided by your WACC minus terminal growth rate. Let me check something here. Oh, no, this is right. Sorry. Okay, so basically what this implies is that Google's share price is $3,050, right? And I'm going to move that over here. And this is not what I actually think Google's share price is worth. This is just like a hypothetical example right now. So don't go investing in Google because of what I'm going through right now. All right, but anyway, so right now it's saying Google's worth $3,050, right? This is in the scenario where our discount rate is 8.2%, but let's see what happens when we change it to 10%, right? You can see that Google's share price now has decreased by $800 to 2,217. And that's because our WACC has increased. And if you think about this formula, what we're doing here is we're getting our free cash flow and dividing by 1 plus our WACC to the power of the year that we're in, right? So because the denominator is larger when our WACC is larger, that means that we have a much larger discount, or we're discounting a lot more. So what this just tying everything together, the reason that the federal funds rate and the increase in that interest rate, the reason that it affects the stock market so much is because when we were at 0%, let's say this was like the 0% federal funds rate scenario, right? We have all of, these are the assumptions that investors who are running these DCFs, they're using the assumption that Google, let's say in this example, should be at an 8.2% WACC. But all of a sudden, now if investors are expecting interest rates to increase to 2% by the end of the year or something even higher, if it increases by 2%, now all of a sudden investors have to incorporate a higher discount rate to value the company. And so that's why we're seeing so many stocks, especially high growth stocks whose cash flow is all the way out into the future, they're discounted even more harshly. And so that's why you have companies in the high growth tech sector that have been hit so hard. And so just again, show you again, we have an 8% WACC, $3,050 for Google. Change that just by 2%, and that decreases Google's share price by $800. Now, this doesn't necessarily mean that as the interest rates go up, the stocks will only go down like forever and ever, because obviously that things will have to rebound at some point, and things like a company's earnings will really matter and stuff like that. But right now, my opinion is kind of the macro environment is going to be the main thing that really that's going to be really driving the stock market. And you can kind of see why, right? These increases in the federal funds rate is going to really dramatically affect stock prices. And in a few days, unless you're watching this like a week after this video has been published, I'm going to be making a video about my broader thoughts about the whole macro environment and how it affects the stock and crypto markets. So definitely feel free to watch that if you want to know more of my thoughts about the whole macro environment. And I hope you guys all found this kind of mini technical analysis of interest rates and inflation and stock market interesting. And only thing I want to just really briefly add is that if you want to learn more about just like financial modeling, I do recommend Wall Street Prep. I'll leave a link to them down in the description. They have like a modeling course where it just goes over a lot of the different types of modeling and, you know, things like discount rate, DCFs, like all that stuff. And then also, if you are investing into the stock market these days and buying the dip, I do recommend public.com, which I'll also leave a link down in the description below too. They have, if you sign up using my link, then you'll get some free stocks. And yeah, with that said, hope this video was helpful to you all. Let me know what comments you guys have, and I'll try my best to answer them. And hope to catch you all in the next video. Thanks and peace.